Are you tired of worrying about your 2023 farm profits? Take control of your investments and maximize your returns. Let Advanced Trading help you create a marketing strategy to protect your investment and reduce market risk. For over 40 years, Advanced Trading's non-predictive approach has helped farmers secure and extend profits regardless of market volatility. Our team is positioned to help you make the most of 2023. You never stop working, and neither do we.
Good morning, Nate Durako with Advanced Trading. I'm here with Brian Basting and Michael Reginelli to recap the USDA WASDE report today. A little bit below maybe what some of the bulls were expecting. Corn currently down 8 to 9, beans down 11 to 12 cents, and wheat down 2 to 3. So getting into it, gentlemen, Brian, kind of high level, what was your takeaway from the report here? Maybe more on the focus of acres and kind of what you see from the soy complex.
The acres really gave us a better foundation, Nate, for 2023. USDA usually does that in October, but they did it in September this year. 775,000 more corn acres here in terms of harvested.
Big number.
More than 750,000 acres. It really offset that bit of a drop in the yield. So that gives us a foundation for the acres. Beans was only 95,000 acres higher on beans. So the big number there was, of course, on corn. If we're going to focus, Nate, on beans, USDA did trim old crop carryout 10 million, higher exports. They did trim the yield from 50.9 to 50.1. It looks like the trade was looking for 50.2, so just about in line with the trade estimate here going in the report. So the crop size is 4.146. Trade was looking for 4.157. No big surprise there. What's worth noting, Nate, though, is that they did trim demand. They trimmed crush 10 million, exports 35 million bushel. So the carryout's at 220. Now that's a snug carryout. There's no other way to say it. But the trade was looking for all the way down to about 207, and it was lowest trade estimate was 170. So 220 is snug, but maybe not as snug as what the market was looking for there. A couple more notes, Nate, on the world scene. China. Imports from China were bumped up for old crop, 2 million tons to 102 million. That's the crop year we're wrapping up now, of course. New crop, up 1 million tons to 100 million. So China is still a big factor. The challenge for the U.S., Nate, is that Brazil is still shipping beans from that record harvest. So we're just going to have to see now as these combines roll. But for beans, I'd have to say maybe took a little bit of that bullish edge off, but still 220 is snug going into this harvest.
Good. Michael, maybe a little bit of a recap on the wheat, corn side, kind of what your takeaway was from the USDA.
Yeah, Brian hit it on the acres. Starting with the wheat, there's almost nothing to report. They, I don't know if somebody was asleep at the wheel, but they did not make any adjustments to the U.S. wheat balance sheet in this report whatsoever. So they kind of kicked the can down the road. They did decrease ending stocks in the world for wheat by about 7 million metric tons. Few different reasons for that. I mean, there are some global production issues that were kind of being monitored. So they did get a little more aggressive in beginning to incorporate that with some of the dry and hot weather in a few different growing areas. But on the corn side, honestly, minimal changes. The yield was more or less in line with where the general trade guests expected it to be. A touch higher, if anything. Certainly down from last month. But to Brian's note on the acres, when they increase acres by 800,000, there's actually a net increase to production. So I think a lot of people maybe saw the yield drop, maybe expected corn to pop, and there's a reason we're down 10 cents today. And I would say it's specifically because we actually had a net increase, modest net increase to the carryout despite the lower yield, and zero changes on the demand side.
Yeah, it's just a lot of stuff. When you talk about 94, 95 almost million acres of corn, gives a lot of cushion in that yield.
Yep.
So as we talk about the yield, a lot of volatility this year in the growing season. We went from Midwest, Illinois specifically, one of the driest starts since '88. So we were at one point off to a worse start than 12. And then arguably saw maybe not ideal weather, but pretty close with some timely rains and moisture. So the yield seems to be a difficult thing to gauge every year, maybe more this year given the volatility in the growing season. And I know we saw some tour data yield checks that kind of supported that, a lot of variability within the field. But now we're in the September report. Do you feel like this is a pretty good gauge on where yield might end up, or kind of a bias going forward? And what implications that might have on the balance sheet? Do you feel like there's enough harvest going on to say, hey, we're pretty comfortable at this level, or you feel like there's still a little bit of risk or upside downside in the yield?
No, you did a terrific job, Nate, of introducing the whole story, if you will, on 2023. As we travel here prior to harvest, Michael and I, for example, went out to Toledo, Ohio. Hopefully that it's going to be realized, but some of those folks are saying the best yield potential ever in the East.
Yep.
And so I think we really got to see, I'll defer to Michael, of course, on this, but maybe a regional story shaping up also here in 2023. The East been looking at some terrific yield potential. As you move further to the center of the Corn Belt, I think you did a terrific job of saying basically that the Midwest crop, I'll say Illinois, Wisconsin, was rescued because it was right on the knife's edge there in late June, first part of July. As we move further west, not so fortunate, I'm afraid, in parts of Iowa and parts of Minnesota. Not a disaster, but not as fortunate, needless to say, as we move further east. So again, in terms of regional components there, it feels like the East has some great potential, corn and beans. The heart of the Corn Belt, not as good as last year, but at least stable to decent.
Yep.
And as we move further west, nothing compared to the drought of 2022, for example, in Kansas or Nebraska, but in South Dakota, but not as high as we'd liked it out there. So moving forward, I think we've got a pretty good handle on acreage now. I think we've got to take that at face value that we planted, as you said, 95 million acres of corn. That's a lot of corn. And so the market's going to have to chew through a lot. Yields, I think they're just going to be a story that's going to be written. I looked up this morning, Nate, over the next 30 days between now and October 12th, the next report, about 30 to 33%, a third of the corn crop is harvested nationwide.
Okay.
Close to 40% of the beans are harvested. So we're going to let the combines tell the story now. I think we've done the crop tours, we've done our satellite analysis. Let's let the combines tell the story. Then, Nate, I think we got to watch demand. Remind the viewers that today the USDA bumped up Brazil's crop to 137. 137 is off the charts.
Yeah.
Last year, I believe, was 116, 117. So you're looking at a competition potentially on that corn export front well into 2024.
And they did take corn exports up by 1 million metric tons each, Brazil and Argentina, right?
Yeah, it's going to be a very competitive environment. The one wild card, of course, as viewers know, Nate, is the Black Sea situation.
Sure.
Will any type of crop be harvested this fall, for example, in Ukraine? We'll have to wait and see. But for the moment, Brazil is the king of the world in the export market. So harvest is upon us. Let's let the combines tell the story.
Yep, I agree. So Michael, kind of building off that, it's hard to get away from the acre number.
Yeah.
Potential shifts in yield still, but we should know a little bit more, especially with what looks like a pretty open start to harvest. When we talk about river situation, low water, we need some rain. But the big acre number, it feels like we've got a pretty good cushion to adjust. I know internally on our balance sheet, even if you want to take the yield down further, we're still struggling to get the demand picture to take a sub 2 billion bushel carry out.
100%.
So we're talking a 500 million bushel even downside yield build in the year over year ending stocks.
Sure.
What do you think the implications are as we roll into fall, maybe on what that could be from a spread environment? It's taking a little bit of time to refill the pipeline. Still be patient on things and just kind of manage it by basis, or what's your takeaway on the balance sheet today?
I think well, a couple things. I think you said it well there. I mean, we're coming out of a year, just to remind everybody, of a 1.45 is where for the old crop carryout, heading into what the USDA is telling us today is a 2.2. It's a healthy swing. And we just saw the yield come down. There's been arguments for yield attrition. You look at crop conditions. There's been a general sense that yields maybe need to trend a little lower. The acres number coming up obviously offset that, and then they didn't touch the demand side, and that's where there's a lot of scrutiny, specifically on corn exports at 5.3 this year. That program could really be challenged as the year goes on, to Brian's point on Brazil and just the general competition out there. So if we start seeing attrition on the demand side of the ledger too, all it does is keep that carryout somewhat supported above that 2 billion threshold. And so if we're looking at a 15% plus stocks to use, it doesn't feel like corn is going to be very tight. The two things I guess I would point out would be, one, the bean carryout in my mind is objectively tighter than corn, relatively speaking. So at 220, you know, a 5% stocks to use, that's much tighter as far as like how the bean pipeline is going to feel. We're coming out of a year of where were they today? 250 on the old crop. So we're going into a tighter bean carryout, whereas corn, we're going to be substantially more comfortable, right? So two different stories developing there. As far as like this fall, looking at spreads, the thing that we got to keep in mind though is, you know, when we're actually exporting, you mentioned low water, that's going to cause freight to be somewhat expensive. It's going to be just more costly to move product. And then the other thing I think that it's hard to outguess today, but what's the farmer going to do from a marketing standpoint? Right. And in general, you look at economics, I think the general bias out there is that the farmer likely sells beans before corn. Yeah. That said, you know, I think the back end of the crop year, you know, we get into spring and summer of next year, beans could feel really tight. We kind of felt it this year. We could easily see that situation coming out next year. If the farmer in the U.S. is a pretty heavy seller of beans this fall, though, off the combine and off the scale, we could see that ownership transfer pretty quickly to commercial hands, and that might actually keep the basis under pressure as we work through Ocnove, maybe even into Dece. And that would be somewhat supportive of wider or more carry in the spreads because the market's trying to stretch out that 220 billion bushels or 220 million bushels. Corn, you know, if the farmer's a tight holder of corn, you could maybe see a little back and forth or ebb and flow on the spreads. But the other point too is interest rates are really high, and that creates the potential, not the guarantee, but the potential for spreads to go wider than what we deem historically normal or anecdotal. Exactly. Yeah. So we just want to keep that in mind as well. And as we pointed out, even if the farmer's kind of a tight holder of corn, there's a lot of corn coming at us, like we just talked about too. So we got to be aware of that. Right.
Yeah. We were talking before. I mean, if you take today's yield with the acres, we're talking about 16.6, almost 16.7 billion bushels of stuff in our total supply to start the fall. You know, using our internal Q1 export outlook, questionable feed demand, right? We got some profitability, especially cattle side of things right now, but the numbers are down. You can make an argument that our Dece 1 stocks number, whether that's commercial or farmer hands, I think is the unknown today, but that Dece 1 stocks number over 12 billion bushels, we've only seen that a couple times in history. It's a lot of stuff to manage on top of a potential Argentina recovery from drought, Brazil crop. Got to get through that part of the growing season, but yeah, in my mind, it's hard to offset that giant acre number any way you try to write this scenario, whether it's yield driven or demand driven. You know, we need to be a little bit hopeful of demand. So shifting a little bit here, SEP reports behind us. Harvest is just on the front end. A couple final questions here, Brian. I'll start with you. Kind of from the wheat side of things, mainly weather markets that we're watching and seeing potential changes in the global balance sheet. What are we focused on here over the next 30 plus days? It is
as the U.S. producer, of course, Nate gets ready to seed this 2024 wheat crop. It's in a critical growing season in Australia and Argentina. USDA did trim Australia's crop by 3 million tons today, and they did trim their exports by 2.5 million tons. So there is some concern that number could fall further in Australia. They're going through El Nino weather. El Nino weather, typically, Nate, the largest declines in crop size occur in October report. Okay. So this is a critical month. September month is going to be critical for moisture. Canada is down 2 million tons. Europe was down 1 million tons. The counter to that, however, is that the Black Sea exports were increased again. 1 million tons higher in Russia, 500,000 tons higher in Ukraine, and 1 million tons higher in Kazakhstan. So we are in a residual supplier mode worldwide, particularly for HRW is historically weak export demand. USDA trimmed that 10 million more bushel today, down to 155. So the U.S. is looking at basically taking the residual, what's left over in terms of exports. Now, if that really is a catastrophic situation in Australia and Argentina, maybe that changes. But for the time being, as we're seeing Chicago wheat futures reach a 3-year low, Nate. You have to go all the way back to September of 20 to see 575 nearby futures for Chicago wheat.
So I'm not going to put you on the spot. Where does that put us year over year for insurance, which we're not set yet, but it's got to be down pretty significant from last year then?
Yeah, it's a great question. I'm tracking that. They're looking at the September 24 Chicago contract, Nate, is around, I want to say, $6.40 a bushel,
Okay.
somewhere in that neighborhood. I want to say last year, Michael, what do you think, $8.40 a bushel, $2?
I was going to say 8.25, but yeah,
Well,
you're
8.25,
close. Sure.
$8.40, near $2.
Not to put it, markets
No,
aren't in front of
that's
us right
fine.
now, but
Yeah.
it could shift the acre outlook as we talk about
Big
that
time.
fall seeding. Time will tell here.
I'd add one more thing on that then too, Nate, is that you made, I'm going to backtrack just for a second here on the comment you made on corn. Producers, I think it's important to remember that the 2024 crop insurance period won't be set until February of 2024. Now we're looking at a long way between now and February. A lot can change between the market. We can have some problems in South America. We can have China come in here and buy a lot of corn.
Sure.
But acknowledging that we've got the mountain of corn, if you will, that you just described,
Great
I
point.
think it's not too early to think about realizing that we've got 5+ months here before we set that 2024 crop insurance price. So defend your balance sheet if you're a producer. On 2023, defend your balance sheet, because particularly in areas where that APH will exceed, or your actual yield, beg your pardon, will exceed your APH. For example, in the East, your crop insurance price isn't quite as high as what you think it is this year, because your bushels are higher than your APH. So defend, and it's not too early to think about 2024 to defend that. And I'd add beans in there in 2024. I'm not sure where Nove beans are trading at the moment, but it's an attractive price. I think it's close to $13, somewhere in that neighborhood. Regardless, it's not too early to think about 2024.
Great point. Great point on the that potential insurance impact from a mountain of stuff to eat through, and a lot of volatility, a lot of uncertainty ahead. As we shift over, Michael, for the final question, kind of thinking through scenarios, and you and I talked a little bit prior. From a commercial perspective, you kind of highlighted be a little patient on the spreads. I think at current levels, defendable if you've got to manage time, space, logistics, how that fits into what your fall program may or may not be.
Sure.
As we roll through, and let's kind of keep on this theme of lower than expected farmer selling. Seems to be what we saw down in the Delta. Now we're getting into the Mid-South.
Yep.
What does that mean for a marketing plan for a fall elevator? I mean, do you get ready? DP could be a valuable play this year on the front end. Do you think we see some basis appreciation here after fall if we come on the front end with low farmer selling? Or what targets, generally timing, do you think guys are going to be wanting to hit here, and how DP might play into that?
Yeah, it's going to be, I'll have some general comments, because it's so subjective and case by case based on regionality, what your local crop size looks like, depending on the size and scale of the operation. Like you just mentioned, time, space, and money are kind of the three things that you need if you're a commercial warehouse or you're trying to operate an elevator. And ideally, you got unlimited amounts of all three, right? But that's not
the case.
Nobody has it.
Right.
So we know interest costs are going to be higher this year. We just talked about this glut of corn coming at us. There's basis implications in that, because we have to figure out how we're actually going to handle this crop. So the expectations are, in general, again, generalizing, service fees, storage fees, probably going to be a little higher than normal. Basis likely going to be a little wider or a little cheaper than normal. There's good reasons for all of those things. Those should be expected out there.
Yep.
Because if you can't outguess the pace of farmer selling, the only thing you can really do then is you got to manage your logistics, you got to manage your buy basis, and you try to set fees at a point where you're not giving your house away on the front end of this thing.
Well
There's
said.
a lot of front end loaded risk in the elevator space right now. If you end up getting plugged, you got farmers upset with you, or if you're giving your space away, now you got a merchandising or a financial problem on the back end of it. So we're walking a fine line here this fall, but like you said, patience, make sure that you have your sales locked in when you need to get stuff moved.
Manage that.
And manage your space appropriately via spreads based on what the market's telling you to do. Basis and spreads are gonna kind of drive merchandising decisions this fall in a big way. And if you're a farmer, the other thing I mentioned, wider basis, and I mentioned higher fees. The other thing to be aware of that we're already seeing interest in, or I think that we'll see, is higher movements towards minimum price contracts. Stopping storage, setting floors. Don't let the market take any more away from you.
Protect
the downside, and then instead, buy a call with what you were going to spend on the storage side out on the curve, and you at least can participate if this market does give you a rally. which on the grower side, that's what you should always be cheering for. If you're in a marketing position where you're cheering for lower prices, something's gone horribly wrong.
Great point.
So you want to be cheering for upside, and I think we're already seeing maybe a bit of a shift just based on the crop size towards some growers looking at alternatives like that.
Right. We can not like the price,
Sure,
but that doesn't mean that there's no more downside in it.
That's right.
Just to tie onto that, I had a coworker mention that this morning, that with the drop in volatility, that a March at the money call, I'm not sure what region he was focusing on, but it probably is across space, was cheaper than your seasonal, than your DPs, your storage charges, and your interest costs.
Yep.
So, maybe think about that as we move forward from the producer side.
Yep.
I think that's it. Appreciate the time, guys. Good answers, and appreciate your time.